Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. And today we're taking another deep dive into the archives to bring you some of the best insights from past guests. About a month ago I put together a compilation episode and people seemed to really enjoy it, and I enjoyed hearing some of the insights from these guests as well. You know, there's been so many interviews in the last 6 years. There's wisdom in tuning out the chaos and focusing on what really matters: quality businesses, sensible valuations, and keeping your emotions in check. Today we've got a great lineup of brilliant minds: Andrew Page, Elio D'Amato, Michael Kemp, Stanley H. Teitelbaum, and Scott Phillips, sharing their takes on everything from margins of safety to the perils of chasing the crowd. So let's kick off with Andrew Page from Strawman, talking about why perfection is the enemy of good investing.
Ben Graham, Warren Buffett's mentor, said the three most important words in investing were margin of safety. And that is accounting for the chaotic nature of the universe and how unpredictable everything is. You don't want to base your investment on the idea of everything going perfectly. Business is tough and business is messy. And you've got the best operators, the best business and the best industry in the world, and you're just going to have crappy years because unforeseen things happen. So I might think it's going to earn $1 per share, but maybe I should just assume 90 cents. And I think 15 is reasonable. We can get to what numbers you might think are reasonable later, but maybe I'll knock that back a little bit as well. Now, the more I do that, the lower the real value is, well, as per my calculation that will come out, and obviously lower the better, as we said at the beginning with PE. But if you do it too low, the market might not ever give you that chance. I would love to buy Woolies at $1 a share because I've put the biggest margins of safety in that you can imagine. But the reality is I'm just never going to buy it because it's never going to get to that level.
Yeah.
But it's a nice way of thinking. Don't price for perfection. These are just guesses. Put out your best guess. Adjust for the unknowns and the unknown unknowns. And it just helps you draw a line in the sand. And I think with valuation, people are too focused on coming up with a number. This is my valuation. And I try to encourage people to do it 10 times. Here's my bull case. I think this they'll do much better than I've perhaps given them credit for, and the market will be in a much better mood. So you can test a variety of assumptions, and you obviously get a variety of valuations. But that process will at least know what your spread of options are, and
the spread of possible outcomes.
The spread of possible outcomes, and then I can sort of use that to benchmark as the company progresses. So on one scenario, I said they should be able to grow their earnings at 10% a year. They had a pretty ordinary, maybe that was optimistic of me. And I can sort of course correct along the way. And it helps to have, you don't want to take your number too seriously.
Yeah.
But you don't want to just be buying on hope.
That's right.
You need
something there to base your thesis on.
This is the problem with the analysts, I would say in the main, is that they get sucked into the allure of false specificity. It's this false confidence that mathematics give you. I'm using very sophisticated maths and spreadsheets, and it makes you feel very confident.
So like when you see that view that says this stock is undervalued, it's worth $10 and it's currently trading at $6.
Except it'll be to 12 decimal places, $10.12. It's hyper specific. It's like, at best it's around $10, and so you've got to take it with a grain of salt. And it doesn't really matter to your investment returns. You may have calculated based on a desired 10% return. If in the fullness of time it comes out at 8, 9, 10, 11, and directionally you're correct. You're never going to lose any sleep. If this turns out to be HIH Insurance or Enron or something like that, again, what does it really matter that your evaluation was? The end result was zero. And what it does is you've got to have a bridge between what the company itself is going to do and what that means to me as a shareholder. I'm a fundamentals-based investor. I'm not relying on what whims of the market are going to be to determine my share. It'll be the operating performance of the business. And all of these techniques, all they do is they link the two. And I've always found it really appealing because at the end of the day, if a business performs well, the share price will generally follow. The caveat there is provided it was priced sensibly in the first place. But that's really what you're trying to get at here. And it means that you can worry far less about all this up and down and daily volatility. And it's just, now my focus is the business. If this wasn't listed and I was just a billionaire and I was going to buy this thing outright, what would I want to know? How much money can I make out of this thing? Based on the cash flows I think this economic machine can generate, what would I pay for that? And this is what does your head in a bit. It is entirely possible to do really badly in a really great company if you pay too much. I don't know, let's pick an example. CSL's a great company. It's one of the best on the ASX, I reckon. I don't own shares in it, by the way. It's a whole other story. I did and then didn't. Anyway, now, is it a good company? Yes. Will it be around in 10 years? I'd say so. Will it be earning more money in 10 years' time? I'd say so. Probably at a decent rate of growth. Would you pay $10,000 per share? I wouldn't, because even if the business does incredibly well, you're not going to get anyone who's prepared to pay that much of a premium down the track for you to do well. So that's the first thing. No matter how wonderful a business, you can overpay, and if you overpay, you can do badly. You can also do well in pretty bad businesses. The example from before, let's say that it was a company that was going to go for 2 or 3 years and then go bankrupt. Well, it's still going to make some money over those 3 years. Let's say on a discounted basis, it's going to make $1 million. Well, I'd pay $500,000 for it. Don't care that it doesn't, because I'm going to put out my internal rate of return, another calculation. I'm going to put out $500,000 on day one. And after 3 years, adjusting for the discount rate, I'm going to get $1 million back. This is a business that just went bankrupt. It's great. So valuation matters.
It does. I was talking to a friend the other day, and he was talking about 3 companies in his son's portfolio. And one of them was WiseTech, another one was Xero.
Yep.
And the third one, and I can't remember the name of it, is it possibly Cardano? Anyway, whatever it is, you look at the 3 companies, and I can't remember the WiseTech situation. Xero just burns through cash, doesn't it? It just keeps on. People invest and that money just gets spent on marketing to get market share. And it's only in Australia and New Zealand. Whereas this other small company, which is a really good business, has got great numbers, great balance sheet in terms of it's got very little debt, and is paying a fully franked dividend. And its share
can't
price,
get arrested.
Its share price, I like that. Yeah, it can't get arrested.
Isn't that great though? This is why I like small caps, because they sit under the radar for so long.
Yeah.
Xero is actually a fascinating case. The argument, as crazy as it sounds when you sort of say it like that, and I don't want to defend, I don't have shares in Xero, but the rationale would be, the bulls would say, is that yes, there's a lot of money going out the door now, but in the future, so much money is going to come back that it still justifies the price. You and I start a business today. We spend the next 3 years putting $100,000 into it. I mean, money's just going out the door. But in that 3 years, we build the next, I don't know, iPhone. We say, well, the next latest and greatest computer chip technology.
Yeah, as a pair of geniuses.
Yes, we are. It's only a matter of time. And then in 5 years' time, we've got a company worth billions. So it's sort of like anyone looking at our company on year 1, 2, or 3 will go, this is rubbish based on the cash flows alone. So this is where it gets tricky. Now, whether the people are right or wrong with Xero, well, that's for you to determine as an investor. But the market is implicitly saying, given the cash flow scenario, that no, we think that cash flow will come. It happened with Amazon. That's the archetypal scenario. I mean, Jeff Bezos famously just bled cash for ages, but then built one of the strongest moats in the planet's history. And we all know what happened with Amazon.
That was Andrew Page from Strawman, reminding us not to price for perfection and to build a margin of safety into our investment decisions.
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Now, a gear shift. How do you know a good business when you see one? We've got Elio D'Amato, recently from Stockopedia, who breaks down the factors that drive market performance, quality, value and momentum, and why they matter more than you might think. Elio D'Amato giving us a crash course on factor investing.
So in the past, I was defined obviously by the previous product and the service that I looked after. But really at the ground root of it, what I was a quality investor. Ultimately, I had a very firm belief that if a company was good quality, that the share price would look after itself over the long run. Keep being good, then the price will just do what it does. And that yielded me some very strong performance. Now, the concept of quality stems from a whole world of academia. And there are what we call factors that drive market performance. So you could find particular traits in stocks, like Stock Doctor used to do with its 9 golden rules. You can find traits that obviously drive performance. And there's periods where it does better and there's periods that they do worse. But if you identify them and can see them, one, you can invest according to them. And two, it clearly explains why things might be occurring at this stage. Now, if I go back a little bit further, I'm going to take you back to 1992, Phil, where two chaps, Eugene Farmer and Kenneth French, wrote in the June edition of the revered American Finance Journal. Now, actually, they wrote about 40 pages and it appeared at page 427, towards the back there. But that little paper they wrote was called The Cross-Section of Expected Returns. Now, it's funny because this obscure little report, which appeared near the back, was actually going to turn the entire investing world on its head in one foul swoop, and it completely ended 3 decades of previous market thinking, and it also basically made my university degree worthless. What it did was it identified, well, the previous thinking was, market returns, they're fixed. You can't really generate better than a market return. You do get a little bit of outperformance and underperformance based on volatility and risk, but basically your market return is set. Whereas Farmer and French...
So can you just define market return? So this is how much you're going to make out of the share price and dividends? Is
correct, that's right, yes. So over expected
yeah.
period of time, what sort of annual return are you likely to expect? And
is the old way of thinking about it, so I just want to break into this and break this down into its constituent parts. Is this because the market tends to price businesses and stocks at the value that they're worth, and so no one's ever going to outperform anyone? Is that what's happening here?
Not quite, no. That was the basic idea of this, is that you can basically spend all your time trying to do valuations and all that sort of thing, and really it's not going to matter because your share returns are pretty much already predestined for you, and therefore, yes, you'll get a little bit of better performance or underperformance based on the broader volatility and risk of the market at any particular time, but your expected market returns were always going to be consistent. And that was known as the capital asset pricing model, or CAPM, whereas Farmer and French actually proved within this obscure little 40-page report with a few graphs and a couple tables and a lot of acronyms that you could actually identify certain factors which could drive performance that was actually returning different results than you would normally expect. That there wasn't a consistent broad market return that would predestine your fate, that you could actually achieve better performance by identifying key factors. Now, they ended up calling it a 3-factor model, but since then, there's been a stack of academics and professional investors alike who have spent their entire life in identifying what factors drive market returns in order to find that edge. And really, that's what Stockopedia does by putting that, or the results of that, in everyone's hands.
Can you talk about a couple of those factors?
Yeah, sure. So the culmination of all this is that there are 3 key factors that drive market performance across the world, that is. So this isn't just localized. That's quality, value, and momentum. And I'll break them down. Quality is the quality of the business, a good return on equity, for example, return on capital employed, all those measures like financial health, even those measures that allow you to assess the quality of a business. And then you get value, which implies what you were talking about with regards to understanding the value of a business. You know, buy cheap, sell expensive, those sorts of primal instincts. Well, those measures, such as price to equity, even dividend yield falls within there, price to sales, all those measures are captured within a value factor, and they can, as a collective, drive market performance. Now, the final factor is momentum. And momentum is a combination of price momentum. So whether we like it or not, particularly here in Australia, good performance drives good performance, and often prices that go up tend to keep going up. Often that's because the company's still good and improving and all those other sorts of things. And then also you look at momentum from the perspective of analyst revisions on a stock. So it's not just enough to see price going up, but is the general disposition of analysts that do the whole interviewing and the question asking and all that sort of thing, is that been actually improving over time as well? And if you combine a stock that's going up in price and has the support of the broader market and the research fraternity, then that too is a factor that drives performance. So if we can cast our mind back to 2008 when it was the GFC, you'll remember that that was a prolonged correction, some 14 months. Now, at the time, as a quality investor only, I was urging people to see it as an opportunity to go out there and get aggressive in regards to the market. Of course, time proved me correct. However, the problem is that when you're in the moment, if you are the type of investor who requires to live off their own earnings that they don't have a consistent cash flow coming in, they may not have the patience or time or inclination for that matter to wait for a recovery. I mean, a correction of 50% means it has to go up 100% just to make your money back. So not understanding that conundrum was something I didn't respect at the time, but all of a sudden I definitely gained a stronger respect for under my current predicament. And that meant I had to introduce an element of that. And that was incredibly supportive because it kept me in the market, even when I thought that things were silly and stupid and every urge in me was telling me that things can't keep going like this. I stayed in the market until such point I wasn't, when I thought everything was okay, and then everything started to trek down a little bit because the run's already been had and I've been able to protect my capital. So I said 2000 and 2021 were my best ever investing years, but to be honest, 2022 was actually more successful, not from a performance perspective on the upside, but because I was able to retain the gains that I'd made the previous 2 years. And that was so useful. And it's obviously very key when someone such as myself, who is not yet allowed by the government to actually claim their superannuation. So
Elio D'Amato there with a crash course in factor investing. Our next guest is Michael Kemp, the author of The Ulysses Contract and a seasoned investor. And he takes us back to the chaos of the 1987 crash to show how crowd psychology can send prices haywire and why sticking to the fundamentals and dividends might just save your portfolio. Here's Michael.
There are people on the other side of your trades, and when there's a lot of people involved, sentiment can become unified, and that unified sentiment can really be quite strange in the way it sends the market in the wrong direction. I don't know if you've seen a book. It was written by a Frenchman called Gustave Le Bon. He wrote a book called The Crowd in 1895. And in it he said, in crowds it is stupidity, not mother wit, that is accumulated. You know, apparently there's safety in numbers and it does protect us in the wild. And, you know, but when it comes to the stock market, it's not necessarily the case. I saw it firsthand in October 87. I wasn't long into my financial career at that stage. And you may remember, or some people may remember, others have read about it, that on the 20th of October 87, the stock market in Australia plummeted by 25% in one day. Now, 25% is not a number. That's a gut-wrenching emotion. And there was total capitulation that day. But here's the crazy thing. What caused it? The Aussie market collapsed for no other reason than the US market had collapsed by 23% just hours earlier. We just blindly followed their lead. So it begs the question, why did the US market collapse? Now, you'd think it'd be a case of Captain Obvious, why any stock market sheds a quarter of its value in a matter of hours. But in the 4 months following the Wall Street collapse, there were 6 independent US investigations in an effort to determine its cause. And they didn't produce a single defining explanation. It was simply a case of mass hysteria. Someone got scared, and like a herd of frightened antelopes, investors around the world just started stampeding. What I found interesting is that a guy called Bob Shiller, he's a Yale professor, and he wrote that best-selling book, Irrational Exuberance. You may have read it. He did a survey in the wake of the 87 crash, and he asked people why they sold. Now, this was a survey to market professionals. We're not talking about mums and dads here. And the most common answer was that people sold because the market was falling. They didn't have a reason. they were just joining the stampede. But here's the thing, if you'd remained fully invested in a simple no-brainer broad-based portfolio of Australian shares prior to the crash, if you remained invested to now and had invested all the dividends you'd received over that time, then your portfolio would be worth 14 times what it was worth pre-crash. There was never any reason to be fearful at all. As I said, I don't want to go through them all, but one I need to mention is, I describe it the soothsayer siren, people who make predictions. Some of the most seductive sirens you're going to hear are economists, particularly the ones that predict the future. But I love that quote from the financial historian John Kenneth Galbraith, who said it well. He said, there are two types of forecasters, those who don't know and those that don't know that they don't know. The reality is they get it wrong far more often than they get it right, and few people bother to check how the predictions turned out. But some people do. I mean, the evidence that they get it wrong is copious. Just read the works of people like Philip Tetlock or Dan Gardner, Alfred Coles, Tversky and Kahneman. The problem here, Phil, is that, and why people believe economists, is because the predictions are usually delivered as a narrative. But the problem with narratives is that the narratives regarding the past and the narratives about the future sort of sound the same. People blur them into one, but they aren't the same. The past is fact and the future is crystal ball gazing. All that has to happen for a narrative about the future to be accepted and believed is for it to sound credible. And some of those economists, when they start talking, econobabble on TV, they sound very convincing, but I always like to say to people, when an economist comes on TV, use the time constructively, get out of the chair and go and make yourself a cup of tea.
I think John Kenneth Galbraith was also famous for that other quote, which is, the role of economic forecasting is to make astrologers look good.
Yeah, I think Buffett's repeated that one too. I think charting, people love looking at charts and interpreting things that should not be interpreted. I tell in the story, the book, about the V1 and V2 rockets in the Second World War. This is pattern-seeking behaviour that humans seek. The V1 and V2 rockets, the Germans were firing over London, into London from the French coast. They were extremely inaccurate. They couldn't be targeted the way missiles are today. An inordinate number hit the East End of London. So the Londoners thought that they in fact were accurate and the Germans were targeting the East End. The Germans knew they weren't. But in the wake of the war, a statistician proved that what Londoners were seeing, the high hit rate in East London, was in fact random. But this gets back to finance. A lot of chartists, they put their faith in charts, heads and shoulders and, support
pennants,
and resistance and all
flags.
this. Pennants and flags. They've got every shape, and it's like looking into the night sky and seeing things up there amongst the stars. I don't believe in charting. I believe that what chartists are doing is trying to find order in randomness. In fact, I talk about a study in the book where a statistician called Holbrook working generated charts from random sequences that he just generated. They were fake sequences. They meant nothing. And he showed them to professional traders who used charts in their daily work, and the traders couldn't tell the difference between working's fake charts and the real ones. And high returns is another siren. Unrealistic expectations of returns.
Well, I was just going to bring that up because I think that's one of the problems, is that when people first start looking at the stock market, that's what they're expecting. And they see something like a 5% jump in a share price and they think, oh, that's not really good, very good, is it? I'm thinking, aren't we going to make 50%, 100%? Are we going to make life-changing gains here? But that's not the way to approach the market, is it?
No, the biggest return you're going to get from stocks, I hate to break the bad news, but I totally accept it, is from dividends. If you look at the long-term returns on stocks in terms of capital gain and then adjust them for inflation, they're fairly mundane, between 1% and 2%, whereas dividend yields are, 6% before tax. It's the compounding of dividends and reinvesting those dividends that will generate the returns that you should expect. The stock market delivers a long-term average return of around about 9-10% before inflation, about 7% after. And if a person expects higher than that, then they might achieve it through luck for a short period of time. But in order to develop skill to generate higher returns, it takes an enormous amount of skill and an enormous amount of effort that's beyond the pay grade of most investors.
That was Michael Kemp on the madness of crowds and why chasing patterns or hot tips can lead you astray. And of course there's his book, The Ulysses Contract, which I'd highly recommend as a great read. Our next guest is Stanley H. Teitelbaum, a clinical psychologist turned investing commentator who explores the emotional side of the game, particularly the idea of shame and why cutting your losses can be a smarter move than clinging to hope.
Well, you know what's interesting about the noise? For me, the most interesting thing is that whether it's on CNBC or other shows, they're always touting the latest thing that you should do this or do that or buy this or buy that. But what's really interesting is they almost never recommend a sell. It's very, very rare that any financial expert, so-called expert, is recommending a sell. So the noise is always in the direction of buy, 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 buy. And that doesn't always pan out. And you have to be able to tune out the noise and follow the basic principles about investing.
There's a quote from the book, and I found this really interesting, and this is about a study by Gustav, I'm not sure about the pronunciations, Gustav Torngren and Henry Montgomery, that found that when professionals said that they were 100% confident in their picks, they were actually right less than 12% of the time.
That's right, which tells you a lot about how much faith you could have in a lot of these professionals, which leads me to another quote, which is a quote by Albert Einstein, who said, "A foolish faith in authority is the worst enemy of the truth." Albert Einstein.
Oh, that's fantastic.
A foolish faith in authority. So if you're listening to those experts who are telling you about the royal road and it doesn't work out, and very often it doesn't work out because they're, as you just pointed out, they may be right 12% of the time, according to this study that you quoted. That's not a good track record.
Yeah, but it's like that, my favourite quote from William Goldman, who wrote that book about the movie business. He was a movie screenwriter. And his quote is, "Nobody knows anything."
Yes, which reminds me of another quote by Robert Frost, which is, "Nothing gold can stay." That was my experience with that stock that went from 5 to 95. Nothing gold can stay. Be prepared for the letdown.
I'm interested to hear more about shame, because this is an emotion, and I know personally I've felt it, and you've obviously felt it as well, and many people that I guess have been on your couch have felt shame. So tell us a little bit more about shame and investing.
Yeah, shame is a very powerful emotion, and it kind of highlights the meaning of shame, that you're defective or deficient in some way. So if you invest in a stock that goes south, you're a loser and you feel shamed about having made that investing. It means you're deficient or inadequate or defective in some way. And again, there's a famous quote by Peter Lynch, who was the manager of the Magellan Fund for many years and one of the most successful fund managers in history. And Peter Lynch said about shame, this is a quote, "There's no shame in losing money. Everybody does it. What is shameful is to hold on to a stock, or worse, to buy more of it when the fundamentals are deteriorating." So there again, that speaks to the importance of cut your losses, cut your losses, cut your losses. If you hold on and don't cut your losses, you're at greater risk for a small loss becoming a big loss. And then the level of shame extrapolates exponentially. Stephen Cohen, who is a very famous hedge fund personality, has said he's got a bunch of portfolio managers and he's worth billions of dollars now. And he claims that if his portfolio managers are right 55 to 60% of the time, he's thrilled. That's how they make their money, which means they're wrong 40 to 45% of the time. The implication of that is if you can cut your losses before they morph into large losses, then you could be right less than half the time and still be a big winner in the stock market. So all of these points from history and from quotes from what other people are saying are useful informations.
It's interesting that you give that statistic, because I had another guest a while ago who came on and said it's so counterintuitive to think that way, because you wouldn't want to go to a surgeon who is only right 55% of the time, for example. And people are just not keyed into that way of thinking, are they? I just wanted to give you another quote from the book, and this can lead us into talking about financial advisors, is that too many of us have internalised negative attitudes about ourselves as inadequate when it comes to managing our own investments. And this is possibly why people do turn to financial advisors, who you believe are sometimes not the answer.
Well, you know what? Psychologically, especially for new investors, it's understandable, it's natural that they don't have a lot of confidence in their ability to invest. They're new at it. They're just starting at it. So there's a part of them that then is kind of looking for kind of a guru to connect with. Hopefully will lead them to the royal road, to the land of riches. And so for those who then choose to connect with a financial advisor, one of the things that frequently happens is that there's a power differential. So the expectation is this financial advisor is going to be so much more knowledgeable than I am. And in many ways he is, but it doesn't mean that he's infallible. And we are discovering more and more that many of them are quite fallible. But the investor tends to be more deferent to the new financial advisor because he feels, I don't know very much, and he's investing a lot of hope in the portfolio that he's going to create with the help of this financial advisor. So it's about looking for the guru, looking for someone who's going to help me find the magic way, and approaching that usually in a way that has a certain amount of deference to an authority, maybe more than is required. I can give you my own tale about that. In my book, I call it my 30-year odyssey. I worked with a whole number of I would say about 10 different financial advisors, all of whom failed me. And the first one, who is the one that I stayed with the longest, was someone who was very personable, very likable. He took me out to lunch. He told me about how to proceed, and we forged a connection. And he stayed in touch with me on a regular basis, which was very nice. And he was always respectful toward me. One of the things that was very compelling in how I work with him is every once in a while, this is how I would proceed in buying certain securities, certain equities. And he would call into me and say, Stan, I want you to consider taking a position in stock XYZ. I said, all right, tell me a little more about it. He said, tell me something. He said, because the boys downtown are recommending it. What did that mean? The boys downtown meant he was in a branch office in Midtown Manhattan, and the boys downtown were the research analysts on Wall Street, and they were piping their recommendations at the branch level. But that was such a compelling way to say it, the boys downtown. And it had an aura about it. The boys downtown are recommending. So I would jump in and follow his lead, follow his suggestion about pursuing stock XYZ because of the boys downtown. So I said to him at one point, well, why am I not doing better? And he said, well, to tell you the truth, we don't really know more than you know. I said, come on, you got to be kidding. He said, no, I'm telling you the truth. And you know what, Phil, I didn't believe him. And then I paused and I thought to myself, it's not that I don't believe him. It's that I don't want to believe him. I had put him on my guru pedestal and I needed to keep him on my pedestal. I didn't want to take him off of that pedestal. And so I didn't want to believe his true confession.
Stanley H. Teitelbaum there, shining a light on the psychology of investing and why a foolish faith in authority can trip us up. Now let's wrap things up with a dose of practical wisdom. Scott Phillips is from the Motley Fool, Australia, and he talks to us about the power of patience. In this episode, we talked about the 5 don'ts of investing. We're going to cover 2 here now. It's a little bit of a contrast from what Stanley was saying, because Stanley is a big believer in cutting your losses, whereas Scott Phillips seems to think that selling even slower might just be the secret to long-term success. Here's Scott.
Right. So this is really important. I think for most investors, it's so easy to get caught up with the media and frankly, the brokerage ads and, the take a position type ads or the you should do this, do that, trade in, trade out. There's very much a sense that if you can be active, you'll do well. In my experience, in most people's experience, it's exactly the opposite. If you keep your brokerage and your taxes down, you find good businesses and you hang on, let them do their thing, that tends to be where success comes from. My biggest mistakes have been actually things like selling too early rather than selling too late or selling too frequently. And so that idea of just be sensible, be slow. I tend to like to say buy slow and sell even slower. In other words, take your time to buy, sell more slowly. My average holding period must be, I suppose, 6-7 years for the stocks I own. Just getting it right, letting it do its thing, leaving it alone. That can be one of the really key success stories when it comes to investing.
Okay, let's get on to the next don't, which is don't sell too quickly, though, that you referred to this as well. But what if it's a dog?
Well, here's the thing, right? So I think it does assume you've done the buying properly. So if you've bought the right companies, generally, everyone's going to make mistakes, right? So there are reasons to sell, as you say. If you've made a mistake, if you think you buy for a particular reason, you look back and go, that was wrong or that was silly, then sell. There's no point compounding the mistake by hanging on. But when I say don't sell too quickly, what I'm really talking about here is let time do the work if the company is still doing what it's supposed to be doing. I sold Domino's is a great example, right? We recommended Domino's for our members at, I think it was about $6, give or take. Went to 12-ish, I can't remember the exact numbers, doubled money for members, felt like a genius, and business going reasonably well. Same store sales started to peter off. This is quite a few years ago now. I thought, right, made my money, double money, let's get out, let's move on. So I did, felt like a genius, looks really good on the scorecard. Of course, the shares went from $12 up to at 80 something. So I left a 7-fold return on the table, being too greedy and too quick to sell, because I kind of thought, well, maybe most of it's done. There's an old saying, you don't go broke taking a profit. That's true. You also don't make a lot of money if you take profits too quickly. And so, look, I've made so many mistakes investing, buying the wrong companies. But frankly, if I'd kept every company I bought, including Domino's and others I sold too quickly, I'd be far, far better off, even holding those dogs, rather than selling too quickly the dogs and the good stuff and ruining the missed opportunities.
I was reading about Domino's recently, but in the US, and it's an interesting business because of the profit margins, obviously, on pizzas.
Yeah.
But I think was it about 10 years ago that the CEO of the company actually said how bad the pizzas were? Have you heard about that?
Did in the US in particular. Doesn't do anyone any favours. It's a funny thing. I think this is where, as an investor, it's important to think about who the customers are, not what you want to do. Now, I don't mind a Domino's pizza. My young bloke loves them, so we get them every now and again.
Yeah,
probably more often than we should.
I would never.
But no, right. Well,
anyone who loves Domino's pizzas, but
that's the thing, right? And so that's I think if you think about who the audience is for the product.
Yep.
I had a mate who said years ago he'd never buy Foster's because he didn't like VB, and that's fine. Foster's no longer exists, of course, but hundreds of thousands of Australians love VB. And so it's really important to think about not just, investing in products you would buy yourself. That can be useful, by the way, and a good starting point for investing. But think about what does the rest of the country or state or world do? How are they likely to behave and what are they going to buy? I owned Origin for a while. I've never bought an Origin other than for my wife, Origin bag or dress or whatever in my life. Those businesses that are successful because they appeal to a particular audience. And if you understand how well they do that, whether or not I consume the product in whatever form, B2B, software companies, same thing, business to business. I'm not going to use them directly, but if they work for their customer base, that's really, really important. So getting out of your own head and not thinking about, what would I do, but rather, is there a large enough market? Is that market growing? Does the market like the product? Are they going to spend more on the product? And that's the thing. Domino's, it's cheap, it's easy. It's not the world's best pizza. It's not the world's best ingredients, but they're $5 or $10. They're there in 20 minutes. If you're watching the footy, if you're doing whatever, there's hundreds of thousands, probably millions of Australians eat Domino's every month or every 6 months. There is a really big and growing market there, and that's the important thing. So don't get too caught up in your own head of what you would do. Think about what the rest of the country or the rest of the market might do.
Okay, another don't. Don't give in to envy or greed. And this is where we're getting into the psychology of things as well, isn't it?
And the don't thing is really a psychology story. Investing well it is about what you do to some degree. It is about what you don't do to some degree. It's largely about how you get your head right. Because if you can get the difference between good investors and great investors, Warren Buffett himself says if you've got an IQ above a certain amount, sell the IQ points. You don't need it. In fact, it's probably going to hurt you. Because if you're too smart and too capable, you're going to overthink everything. You're going to be so stuck in the academic process of being right, you kind of miss the basics of get your head right, buy good businesses, hold them for the long term. That stuff doesn't require a huge IQ. If you can just get your behavioral components right, you're away. Now, when it comes to greed and envy, it's exactly that story as well, right? Just because your brother-in-law has made some money on a stock doesn't mean you should chase it up. Just because someone else got rich in a month doesn't mean you should throw away your buy and hold strategy and try and speculate on Bitcoin. It's a very tried and true process of investing by being slow and thoughtful. It is the tortoise and the hare. There's a reason Aesop's fable is a cliche these hundreds of years later, thousands of years later. It's very much that story of just being slow and steady. So just because someone else is making some money is not a reason to invest. Just because you want to get rich quick is not a reason to buy that particular stock. Buy it if it's great. I'm not saying that stocks go up, can't keep going up. By all means, buy them if they're still attractive, but don't do it out of fear or greed or envy. Do it out of really smart, thoughtful, cool-headed thinking, which says, I think this company can be bigger and better. I think the price is attractive. Therefore, I'm buying, not just, I can't stand missing out anymore. If you don't know much about it and your interest gets piqued for some reason and you jump in and you make your first trade, that one will probably determine your future direction. If you lose a lot of money, you might give up. If you make a lot of money, you might think this is easy and start speculating. It's so difficult to get people to that point. I mean, I've had so many people who've said to me, the stock market's a casino. My old man was a bloke who said, it's a casino, it's all the smart money over there, you can't possibly make any money. There are so many preconceptions about investing. And as you say, we're helping people get from the point of, I might be interested to, how do I do it well? And if they listen to your podcast regularly, if they listen to other people who are smart, capable experts who are just saying, look, let me help you slowly get rich. Everyone wants to get rich quick. I would too if I could. But getting rich slowly is far better than going broke quickly. And so if you can understand the fundamentals and work slowly through that process, you will be far, far better off. I can't give guarantees, A, because it would be incorrect, B, because I'm a licensed financial advisor and I get fired for doing so. But I have a really, really high conviction that adding regularly to a quality portfolio of stocks is the best way I know to get rich over a very long term. Not tomorrow, not this year, not even in 5 years' time. But if you regularly invest in quality businesses, the trajectory of the market is up. Yes, there are pullbacks. We know that the GFC or the COVID recession were examples of the market really having trouble. But over any longer period of time, the average return is phenomenally large if you just let it do its thing. So if there's one message for all of this that we're having, and you're doing the same with the podcast generally every other week. But the key message is just keep it simple. Make sure as you invest, you do it smartly and thoughtfully. Don't rush after the latest thing. Don't start speculating. Don't start letting impatience take over. Do it properly, do it slowly, do it thoughtfully. And I know that sounds super boring. I get it. I really do. But I promise you your future self will thank you for it if you just resist the temptation to overtrade or to try and chase the latest thing.
If you've enjoyed this trip through the archives, let me know what you think, and maybe we'll do more compilation episodes like this. Until next time, happy investing, and I'll catch you on the next Shares for Beginners.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.